A single dry season turns a brush fire into a statewide crisis in days. Right now, the market for acquiring fire safety businesses is igniting. The fire protection industry is currently in the middle of a massive wave of consolidation. Larger entities are actively buying up independent operators at a volume we rarely see. What you are watching is a strategy called a roll-up. Private equity firms use their capital to acquire multiple smaller independent shops and aggressively stitch them together to form dominant regional monopolies. This line chart shows how that sharply rising trendline of M&A activity is intersecting perfectly with a temporary window of peak valuations. If you own a fire protection company, buyers are willing to pay a premium for your customer base right now. This puts you in an immediate dilemma. You can sell your business as is today to catch the wave before it breaks, or you can delay the sale to properly prepare your operations and push for maximum value. If you hesitate and fail to make a deliberate choice between speed and preparation, the window will close. You will leave life-changing, generational wealth on the table simply because you didn't commit to a strategy. Most national advice on how to sell a business assumes a level playing field. Operating in California completely changes the rules of a standard exit. The state of California faces unique environmental risks. Consistent threats from seismic activity and wildfires have forced California to implement some of the strictest commercial fire and life safety codes in the country. Beyond your top-line revenue, buyers will heavily scrutinize your adherence to these state-specific codes, auditing both your own facilities and your record of compliance on client properties. A highly profitable balance sheet is entirely meaningless to a buyer if the business carries heavy, localized compliance liabilities. A private equity buyer comes to the table with massive capital reserves. But they also operate with zero tolerance for operational risk. Securing a premium valuation from a PE firm requires your business to survive forensic, brutal due diligence. They will audit every contract, every process, and every piece of equipment you own. During this review, they focus heavily on seller's discretionary earnings, or SDE. This metric strips out your personal owner benefits to determine the true transferable cash flow of the business. Compare that to selling to a regional competitor. A local rival might offer you less total money, but they already understand the local market and will require a far less intense review of your day-to-day financials. The type of buyer you target directly dictates your payout. The more rigorous the buyer, the more heavily your messy bookkeeping and undocumented processes will penalize your final check. Deferred maintenance on client properties or your own facilities is the fastest way to kill a pending deal. This 2x2 quadrant chart gives us a framework for evaluating which pre-sale fixes are actually worth your time and money before you go to market. Ignoring basic issues like aging fire alarms or blocked emergency exits offers you short-term relief on your budget, but as you can see, it severely damages the sale when the buyer eventually discovers it. Conversely, proactively investing capital to update commercial electrical panels to modern California codes requires effort, but it directly protects your asking price from downward negotiation. Successfully completing a full California seismic and wildfire code audit places your business in the absolute peak of the maximum impact zone. It makes you a premium, low-risk target. Buyers do not overlook compliance failures. They use them as leverage to aggressively renegotiate the purchase price downward at the closing table. Proactive compliance upgrades function as direct dollar-for-dollar defenses of your final exit valuation. Revenue from a new installation is a one-off event. It pays well today, but it is unpredictable. Stability comes from ongoing maintenance and monitoring contracts. Institutional buyers want predictable cash flow. Because of that, they apply significantly higher valuation multiples to businesses that are heavily weighted toward recurring revenue. The trade-off here is straightforward. Pivoting a business model to secure and service these long-term contracts takes months or even years of dedicated operational focus. The time you spend building recurring revenue today acts as an exponential multiplier on the cash you receive on exit day. When you structure the deal, you face a major decision. Are you selling the physical assets of the business, or are you selling the underlying stock of the corporate entity itself? This structural choice dictates your tax burden. California has separate state capital gains taxes, and the way you classify the sale changes exactly how the state taxes your proceeds. This is why hiring specialized M&A advisors and tax professionals 12 to 24 months before you list the business is a non-negotiable requirement. The friction is that these consultants require high upfront fees, and they offer absolutely no guarantee that your business will actually sell. But navigating a California exit without expert tax structuring guarantees the state will take an outsized, unnecessary cut of your life's work. To figure out your next step, this comparison matrix matches your burnout level against financial goals. The valuation optimizer delays their exit by 2 full years, spending that time implementing audits and cleaning up their SDE. This strategy requires surviving private equity due diligence, but secures the maximum possible ROI. Conversely, the fatigued founder is burned out. They prioritize a fast, as-is sale, usually targeting a regional competitor. They successfully buy their freedom quickly, but accept a heavily discounted price for inherited compliance liabilities. Finally, the legacy builder rejects roll-ups entirely. Preserving staff culture and ensuring continuity for customers is their highest priority. The trade-off for protecting that legacy is financial. You will likely accept a lower multiple, and you may have to personally finance a portion of the sale to make it work for an internal buyer. There is an unshakable rule in the California fire protection market. Your exit valuation is determined purely by how thoroughly you de-risk the business. Avoiding California code upgrades or messy financials doesn't make the problems disappear. It just transfers the cost to the buyer, who will deduct it from your check. By honestly identifying which type of seller you are today, you stop chasing impossible deals. You can focus your limited energy on the exact preparations that will secure your ideal exit.